Hello and welcome to another video. This video is all about mean reversion trading strategies. In the video I'm going to show you what mean reversion strategies are, how to trade them, and I'm going to give you some effective entries and exits that you can use, how not to trade them, because this one's really vital. This is where a lot of people make mistakes, and how you can improve the mean reversion trading strategies that you decided to trade. And then I'm going to talk about what markets to use mean reversion trading strategies on. And I'm going to give you an example. We're going to look at two different Forex pairs with the same strategy, and I'm going to demonstrate why it's very, very important to choose your market carefully to trade with mean reversion. And as a bonus, I'm going to give you the rules to a mean reversion strategy that you can take away and trade straight away. So first of all, what is mean reversion and what's a mean reversion trading strategy? Well, you've all seen price charts and you've all seen prices just go up and down, fluctuate in what looks like no order whatsoever. And I expect if you've tried to trade them, you're probably convinced that there's no order in the markets whatsoever. But some markets, and I say some, and I'm going to touch on that a little bit later, some do have some sort of an order. They decline and they go up, but then they revert to what's called the mean. And that's where the mean reversion gets its name from. The mean as in an average price. Imagine a price chart and then apply like a moving average. You've all seen moving average lines, like a 20-period moving average that follows the price quite closely. And you'll see prices that go above the moving average line, back below the moving average line, but as they're going back and forth, they come back to this mean or this moving average mean line, and that's where the reverting to the mean comes from. If you imagine that mean or that 20-period moving average was the average price, and then prices stretch above or below, and if we've got a relatively good idea of how far the market goes up or how far the market goes down below that mean, if we get some sort of a tool, and we've got tools to do it, if we have an idea of how far that will stretch, we can then take advantage. So if the market is stretched below that moving average and we've got a good idea that that's about as far as it's going to stretch, we can then buy and know that it's going to come back and rally back to that mean. And the opposite works in the other direction. When prices rally above, they're overbought as it's called, and then we can short sell the market and prices hopefully will then decline back to that moving average or the mean. Like I said, luckily we can use technical tools to give us an idea of when the market's stretched away from that mean. We can use oscillators, tools like RSI, Relative Strength Index. If the market is overbought, that means it's stretched above the mean, then we can see an extreme level in the RSI, and we know that could be the time to short sell the market because it's going to come back down. And if it's oversold, the market's dropped below that mean and the RSI is very oversold, then we know at that level, then if we buy, markets are probably likely to rally back to that mean, and that's a buying opportunity for us. Another tool that we can use is Bollinger Bands. You might have seen Bollinger Bands. We've got that center line, which is effectively just a moving average, and then we've got the line above and then the line below. And what we can do is wait for prices to hit that above line, and that can give us an indication of when prices are stretched to the upside so that we can enter a short sell and wait for prices to drop back to the mean, and opposite for a buy trade obviously. Or we can just do basic things like, for example, look at, is the closing price of the market the lowest close over the last 5 days, meaning that we've had an extreme amount of decline over the last 5 days and the market's stretched below what it normally is and it's bound to bounce back. So we can use simple stuff like that without even putting indicators so much on our charts. But we can also improve these signals even more. Now, a classic example is looking at the longer term trend. Let's say we're looking at a daily chart and we're looking at an RSI. So we're looking for buy signals when prices have dropped down below that mean, and we might use RSI and we might be looking at a very oversold level, an extreme oversold level that's telling us when to get in. something which will improve the reliability and the profitability, is if we're only taking buy signals when the overall longer term trend is up. So we can do that by just applying a 200 period moving average to the price and say that if the market's above that 200 period moving average, we're in a bull trend. So we're only going to look for buy signals. If the market is below the 200 period moving average, we're probably in a bear market. So we only look for short sell signals. And I've previously recorded a video demonstrating how to use RSI to trade the S&P 500 in a mean reversion way. I'll link that above, or I'll link that in the comments below so that you can have a look at that. So now we've talked about how to identify when these markets are overstretched either way. When do we actually get in? When do we actually initiate the trade? Well, there's a couple of ways. In the example that I talk about using RSI on the S&P 500, we're looking for buy signals, so we're looking for the RSI to become extremely oversold, and we actually enter the market as soon as it becomes oversold, and we're actually getting in while the market is still actually declining. So that's one way. Or there's other ways where, Bollinger Bands, for example, we could look for buy signals, market to come down, market to close outside of the lower Bollinger Band, but then maybe return and close within that lower band. And so what we're looking for is confirmation that that decline has finished and we're on our way back up. So we can look for buys as soon as the market's closed above that lower band and get in then. Both work, but as always, I encourage you to test them on whatever market you're trading. So now we're in a trade. What about exits? Well, with mean reversion, we're often looking at short-term trades. We're looking to take advantage of extreme moves and then get in and then ride that move for a few bars or a few days, depending on the time frame. We're not looking at jumping on a trend and holding it like a trend trade. So normally the best type of exit on a mean reversion strategy is after you see like a sharp rally in a buy trade or a sharp decline in a short trade. So let's say we're buying and we've seen our RSI or our oscillator show us that prices have dropped over the last 3, 4, 5, 8 days, and it's time to get in. We buy and we're literally waiting for a quick sharp rally. In the Bollinger Band example, we bought down near the bottom Bollinger Band and then we're waiting for a quick rally and we exit near the center line. With RSI, we can measure that quick rally as well. So let's say we've bought when the RSI is at a low level, say 10, and we wait till RSI rallies above and it gets to say like the 70 level. There's many different ways, but essentially as soon as we've had that quick rally, we're going to take advantage and get out before the trend then reverses again. Now here's where things get important. And I mentioned at the start of the video, I'm going to tell you when not to use mean reversion trading strategies. You see, the thing is, all markets have their own kind of personality. They all move in different ways. And some markets are more mean reverting than others. Some markets are more trending than others. So you try using a mean reverting trading strategy on a trending market and you're going to lose. Do the opposite. Try using a trending strategy on a mean reverting type of market and you're going to lose. So the best way is to test it out on each and every different market that you want to trade. It's very important to understand how the market and the time frame you're using behaves in terms of mean reversion or trend. And I just said time frame. Let's look at the S&P 500 again. On a daily time frame, the S&P is very mean reverting. Using that RSI overbought, oversold type strategy works very well. But you use exactly that same strategy on a 30-minute chart or a 10-minute chart and it won't work. So it's very important to understand when and where to use the mean reversion strategy, and easiest way is just to test it out. And I've prepared a great little example to show you differences between two different markets. We're going to look at a mean reverting strategy on euro dollar and on dollar yen. Both a 30-minute chart, both exactly the same strategy, vastly different results. Let's have a look at the computer now and I'll show you what I mean. Okay, this is how this strategy looks on the charts. So as I mentioned, I've got both the markets here. I've got euro dollar in the top one, dollar yen in the bottom one, both 30-minute chart, both the same strategy. So have a quick look on how it works. So I've put the Bollinger Bands on this chart, and it's quite simple. I'm not going to go into all the detail, but quite simple. Looking to short when the market gets towards that upper Bollinger Band, expecting it to have rallied and decline, and then buy when the market drops down near that lower Bollinger Band. Okay, so it's short, but here we don't get that buy signal until prices reach the lower Bollinger Band. So pretty straightforward. Now, let's have a look how they perform. Same strategy, different market, same time frame. Euro dollar, all we're going to do is look at this equity curve, and I think you'll agree it's quite a nice uptrending equity curve showing data from 2008 through to 2020. Now, how does it perform on dollar yen? As you can probably expect, it doesn't perform very well. Now, look at that. What a difference that makes. Same strategy, same time frame, but different market. Now, that's a really good demonstration of how different markets behave differently. Euro dollar is obviously very mean reverting, especially on that 30-minute time frame, but dollar yen, certainly not. I have a lot of success trading the yen pairs, euro yen, dollar yen, pound yen, with more trending strategies, trading breakouts, which is the opposite of mean reversion. Guys, if you like this sort of video and you find it useful, then please do me a favour now and click the like button and subscribe to the channel, because every subscription really does help me out. I hope you now have a better understanding about what a mean reversion trading strategy is. I've given you some ideas of how to use this approach to trade the markets, including some entries, and I've shown you how you can improve those entries and how to exit the markets too. I've also demonstrated how you should only use this approach on certain markets and certain timeframes, but I also, as always, encourage you to test everything you do. Now, I mentioned that I'd give you a mean reversion strategy, and what I'll do is I'll link that video above or down below as well. And I'll also link down below the direct link to the PDF, which gives you all the rules to this mean reversion strategy, so that you can take that away and use it at your will. So, as always, if you have any comments or questions, please leave them down below, and visit my website where you've got more information just like this. That's thetransparenttrader.com. And until the next video, this is Jared Goodwin, and thank you.